Welcome back to the channel, everybody. I hope everybody is ready for some doom and gloom because I've got some inflation numbers to talk to you about, and it was not a pretty report this morning. So grab some caffeine and let's strap in. So the first issue at hand here is, what is CPI? So CPI means Consumer Price Index, and the big boy definition is that it's a weighted average of a basket of consumer goods and services. But all you should really care about is that it tells us what the inflation rate is on a month-over-month and year-over-year basis. Similar to the CPI, we also have core inflation. The difference there is that core inflation just strips out the food and energy sector numbers from the CPI data. The reason economists like to use core inflation as their measure of inflation is because the food and energy sectors are much more volatile and they tend to skew the inflation rate higher or lower at a much faster pace. So if you strip out food and energy, it makes it look like a smoother transition up or down, whichever direction inflation is trending on a month-over-month basis. Economists like to use the core inflation over a longer time frame to measure inflation, but I tend to like to know the full CPI data because I think if you include the food and energy sectors, you're going to get a much better sense of what consumers are actually paying in the marketplace. This gives you a much better measure of how much the price of the daily goods that you're going to be using increase. So now that that's out of the way, what were the actual numbers that came in this morning? Analysts were estimating a month-over-month increase of the CPI of 0.4% and a year-over-year increase of 7.2%. The actual numbers came in at 0.6 month-over-month and 7.5 year-over-year, which means the goods and services that you were paying for last year were about 7.5% less than they are today. The good news is that economists are saying that the supply chain issues are finally starting to ease and we should see an inflection down in the inflation rate, but they've been saying that it's going to be transitory inflation from the beginning and are just now starting to admit that it might be worse than they had initially thought. As I mentioned before, economists like to use the core inflation numbers, so if you're interested in that, analysts were expecting 5.9% year over year and 0.4% month over month, and the actual numbers were 0.6 month over month and 6% year over year, which is also higher. The food sector, in December, the reading was 0.5%. In January, we had a 0.9% increase in the cost of food. That resulted in a 7% year-over-year increase in the cost of food, and that accounts for food at home and food away from home. Energy prices are up a massive 27% year-over-year. I think it's likely in relation to the price of crude oil soaring past $90 a barrel. I'm sure you've noticed whenever you go to the gas pumps that gasoline is up 40%. Housing prices are up again, 0.5% month over month. This is creating affordability issues in the housing market with prices so inflated. Many people that would be buyers in a normal market are now renters, and that's what's driving the rental prices up. Because with a higher number of renters in the market, the more landlords can charge for the rent. There's obviously more in the report, but those are the numbers that I want to focus on right now. Obviously, the CPI numbers that we discussed are not in good shape. When the market heard the report this morning around 8:30 Eastern time, it slumped off maybe 1.5. It was down over 1% this morning pre-market. It seemed to claw its way back fairly quickly after the opening bell, and then it just kind of bled off for the rest of the day, ending a couple points lower. I think what the market really cares about is what the Federal Reserve is going to be doing at its next FOMC meeting. So let's talk about that. What does the Federal Reserve do? So the Fed has a dual mandate, and the two portions of that are reach full employment and stable prices. They do this by monitoring the inflation rate using these CPI numbers, and they use the data to make changes to the discount rate. The discount rate is the interest rate that the Federal Reserve charges its member banks for overnight loans. That in turn changes the federal funds rate. That's the rate that you've probably heard about before. The Fed doesn't actually change the Fed funds rate, they change the discount rate, which affects the Fed funds rate. So the discount rate is what the Federal Reserve charges its member banks. The Fed funds rate is what member banks charge each other for overnight loans. And that's all due to the bank's reserve requirements. If a bank is low on cash, it must borrow from another bank overnight so that it can have at least 10% of its reserves on hand. So to put all that simply, if the inflation rate is high, the Fed increases rates to try to slow down the economy. If the inflation rate is low, they lower rates to try to stimulate the economy. This works because it's easier to borrow money in a low interest rate environment and harder to borrow money for business ventures, etc., in a high rate environment. There's actually some other functions that the Fed uses to try to affect the economy, but let's just focus on this one for now. So since inflation is soaring 7.5%, the Fed is expected to increase rates. Some analysts are expecting as much as 7 interest rate increases this year, while some other analysts are still sticking to their 3 to 4 interest rate hikes. Obviously, we're not sure which way that's going to go, but we should be able to find out soon. The FOMC meeting is scheduled for March 16th. That is the Federal Open Market Committee. They are the ones that make the decisions on these interest rates. I think that is the date that everybody's going to be watching for in the markets. Yes, there's going to be some other catalysts in the meantime. We get the Fed minutes from January in a little less than a week, and we get the next CPI data on March 10th. But I think the March 15th and 16th FOMC meeting is going to be what everybody is focused on in the market, and I think that'll be what decides the true direction that the market is going to go. The estimation for this March 16th decision is that there will be a completion of the tapering process for the stimulus. That's another thing that I mentioned that the Fed can use to affect the economy. It's called repurchasing agreements. You can Google that, or I can make a video on it later. And the second thing that's expected at the March 16th meeting is an increase to the Fed funds rate. It's forecasted at either a quarter point or a half point, so either 25 or 50 basis points increase to the rate. The CPI data on March 10th can affect the March 16th decision, of course, but I'm not expecting sunshine and rainbows from that report on the 10th. The market is all about outlook and emotion, and the market seems to already be pricing in 5 to 5.5 rate increases this year. So I'm anticipating closer to the higher end of the spectrum on the scale of analyst reports that I mentioned earlier, between 3 and 7. In my opinion, there's a couple ways this can go on March 16th. The first of which is, let's say that the Fed delays the rate increase and continues the tapering process. In that situation, that's going to be a better than expected outcome. I do think the market rallies on that news due to it being not as bad as expected. Again, all about emotion, all about expectations. I personally don't see how that could be the result given the current numbers. I think more than likely we go in the opposite direction at that decision. As I mentioned before, the Fed has 2 objectives. It looks to get full employment and stable prices. The unemployment rate is currently back near pre-pandemic levels, around 4%, and we are in a perpetually transitory state of inflation. I think it would be hard for the Fed not to take a more hawkish tone at the next meeting. So my personal opinion is that we do see a half-point increase in the discount rate at the next meeting on March 16th, though how much can that really do for a 7.5% inflation rate? I think we're in for a much tighter monetary policy than the market is currently pricing in, and I think we see increases of much more than 0.5%. With that, I think we see heavy volatility around that March 16th meeting, and if we get a less than optimistic outlook for the rest of the year, I anticipate lots of blood in the market. I am a huge believer in not trying to time the market, but I would be lying if I didn't say I was hoarding some cash on the sidelines to try to take advantage if we do see a big drop. None of this is financial advice, of course, it's just the way one guy sees it. Thank you guys again for tuning in to my quick and dirty rundown on the CPI numbers this morning. Don't forget to like and subscribe, and I look forward to seeing you guys in the next one.